Today, I get the pleasure of talking to you about income taxes. And yeah, I know you're probably thinking, really? He gets pleasure in talking about income taxes? And the fact of the matter is, I do. Let me share with you why. For starters, when you look at income taxes in their entirety, they're really confusing for a lot of people. When you think about the deductions and credits and exemptions and all the millions of lines, not millions, but all the various lines of tax code, there's a lot of stuff that can just sort of create this dizzying array of information and people don't know what to do with it. Another thing about taxes is they mean losing some of your hard-earned cash. In some cases, maybe a lot of your hard-earned cash to the federal government, who may or may not use it as prudently as you do. And the final thing here is that taxes can bring potentially negative surprises. Surprises like, surprise, you owe more taxes than you thought you would. Or even worse yet, you could have to pay penalties on top of that. So you might think of all that and say, okay, well, that still doesn't sound like a very pleasurable subject. How could you enjoy talking about it? The answer is, one of the things that clients appreciate most about having a relationship with a great planner is that we're really good at taking complicated, confusing things that can impact their finances and, frankly, their lives, and we make them easy to understand. Another thing clients like is that they like us to help maximize their money. And obviously, less money going to the federal government is maximizing it for their benefit. And the other thing, sometimes we get hired because we help clients avoid negative surprises like the one that I just talked about. So when you think of it from that perspective, you think of it from the client's perspective and what we bring to the table as financial planners, you sort of roll all that together and you can see that the topic of taxes really presents nearly the perfect opportunity to do great work for a client. So with that sort of as a backdrop, let's dive into the subject of income taxes a little bit and talk about some of the bigger things we need to look at. Before we dive into some of the main technical aspects of income taxes we're going to cover today, let's take a quick step back first and talk about how we're at a place where we even need to talk about income taxes. I mean, after all, it wasn't one of the big issues that caused people to come here in the first place and start this country a disdain for how they were being taxed. Well, if you or your clients were ever wondering how we got from there to here, it's really a pretty simple story. In short, for our federal government to do what it needs to do or wants to do, it has to have a source of revenue, and that source is taxes, with income taxes being one of the most significant components. Interestingly, though, the U.S. Constitution, as it was originally adopted, did not give the federal government the ability to collect taxes on income at all. In fact, when it tried several times early on to enact income taxes, the Supreme Court actually declared them unconstitutional. So what do you do when you want something, but it's declared unconstitutional? Well, you change the Constitution, assuming you can get the votes to make it pass. And that's exactly what they did with the 16th Amendment when it was adopted all those years ago on February 25th of 1913. What I find really interesting, though, is how our current super complicated tax system began as such simple language. Specifically, the 16th Amendment reads, "The Congress shall have the power to lay and collect taxes on incomes from whatever source derived, without apportionment among the several states and without regard to any census or enumeration." That's it. That's the entirety of the 16th Amendment. A whopping 30 words. Just 30 words. That's it. Today, the tax code is measured in thousands. And no, not thousands of words, thousands of pages. And so you might be asking, why so much and why so complicated? Frankly, there are lots of reasons for that, but a lot of it just comes down to times changing, national sentiment changing, and the politics of how laws get passed in our country. We don't really need to get into all the minutiae of how we got from there to here. What's important to know, though, is there is a system in place for collecting taxes in our country. It is something that everybody in our country has to deal with. And if you can understand the basics of how income taxes work and explain that to your clients, that's going to position you to be a very valuable resource for them. The other thing that's good to know related to this is that because we now have tax laws, we now also have a legal requirement to pay taxes. And if we don't pay them, we're subject to penalties for non-compliance. Now, from a financial planner's perspective, we probably don't need to deeply understand how the various penalties work, but it is good to know and make sure our clients know that there are penalties for not following the law. For instance, there are failure to file penalties if someone who is required to file doesn't. There are failure to pay penalties if someone files their taxes but doesn't pay the tax they owe by the due date. And there can even be accuracy related penalties for someone who files but doesn't calculate their tax liability correctly. This last one can even be taken further if the IRS deems that the reason for the inaccuracy wasn't just a mistake, but instead was intentional fraud. In that situation, the penalties can be massive and can even rise to the level of a criminal offense, which could mean going to jail. So, as with any laws, whether you like them or not, tax laws have to be obeyed. And if you don't obey them, the consequences can be really bad. So now let's shift gears a bit and start to dive into some of the details of how the tax system works. And specifically, I want to start with sort of some basic structure and approach to income taxes. And what we have here is really a set of three threes, if you will. There are three basic tax systems, there are three types of income, and there are three types of tax accounting that you need to know about. Let's dive into the first one, which is the three basic tax systems. As you can see, there is one, the income tax system, which is what we're talking about here today, where we're going to spend most of our time. But there's also the estate and gift tax system, which is all about taxes that might have to be paid when giving money or assets away or passing things down to the next generation. And then the third tax system is the generation skipping transfer tax system, which is a tax system about skipping over a generation and trying to push it even further down the line. Again, because we're talking income taxes, we're going to focus on the first one. The next set of three that you need to know about are the three types of income for income tax purposes. They are active income, portfolio income, and passive income. Active income is income that you actively acquire. It's one of those things where you are doing something to earn it. These types of income are typically subject to the highest tax rates. Those rates do change from time to time, but the highest rate, the highest bracket that you'll typically see is usually somewhere north of 35%. So income, ordinary income, can be taxed at some fairly significant rates. Portfolio income, that's basically income from things like investment portfolios. Some types of that income, like long-term capital gains, for instance, which is the gains on the sale of capital assets like stocks, bonds, cryptocurrencies, real estate, those types of things. Those are all taxed at significantly lower rates than ordinary income, depending on your filing status, your taxable income, and how long it was owned. And then the third is passive income. Those are things like rental income, for instance, things where you're not actively involved in the pursuit of it. Understanding these three types of income is important because of this thing called the bucket rule. And the bucket rule basically says that losses in one of these three buckets can generally only be used to offset gains in the same bucket, not another bucket. But of course, as with almost everything related to income taxes, there are exceptions to that. But generally speaking, that's how it works. Gains and losses stay within the same bucket in terms of offsets against each other. The final set of threes that we'll cover here today are three types of tax accounting. Here you have the cash method, which is used by most individuals and small businesses. And that's when income is taxed when it's received and allowable deductions are claimed when they're paid. So fairly straightforward. And this, by the way, is what we as financial planners need to know best and focus on for our clients. And then there's the accrual method, which is usually used by larger businesses. And in that situation, the income is taxed when it's earned, whether or not it's been received, and the deductions are claimed when they are incurred, whether or not they've been paid. And then you have the hybrid method, which is really just any other method of tax accounting that's approved by the IRS that is not neatly defined as cash or accrual. So again, from the basic tax structure perspective, you have three tax systems, three types of income, and three types of tax accounting. Obviously, taxes are way more complicated than that, but this is a great example of how we as financial planners can take really complicated things and make them easy for our clients to understand. For the remainder of this lecture, I want to do a review of some of the bigger income tax topics that are important for us as financial planners to understand. And here's the thing, they're not just important so that we can help our clients from a technical perspective. They're important because understanding these topics we're about to cover and being able to explain them to our clients in an easy to understand way helps demonstrate our professional competence. And that gives our clients confidence that they can trust us. So in the world of income taxes, one of the sort of first things you need to understand is what is the basic formula for going from what somebody makes to what somebody owes. And it really is kind of simple. It starts with just a basic equation of income minus deductions equals taxable income. Then, once you figure out your taxable income, you simply multiply that times your tax rate to get your tax liability. So, again, that is the simple look at how you do the calculation. Here's the thing though, within each of the four components on the left side of these equal signs, so income, deductions, taxable income, and tax rate, there are a whole bunch of details and subcomponents that you need to understand. So let's dive into each one of those things a little bit further and sort of how they're derived in the end. And that will give us a really good structure or foundation for helping somebody understand the basics of personal income taxes. So the first component of the basic income tax calculation is income. And clearly there's more to it than just this one word, right? So you start with sort of this income broadly defined, then you subtract from that exclusions, which are things that are not subject to income tax. And some examples of those, for instance, are interest income from municipal bonds, alimony that somebody might have received if the divorce happened after 2018, child support payments, etc. There's a list of things that somebody can receive. However, they are not taxable for income tax purposes. So those fall into the category of exclusions. And there's a whole list of them and they'll change from time to time. You just need to understand that those items are not included in the tax calculation. And so really you start with that income broadly defined, you take out those exclusions, that gets you down to this gross income number. Then within gross income, that's basically any income items that have to be reported on a federal income tax return because they're subject to tax. Examples are, compensation that you get from work, interest income, dividend income, gains from the sale of assets, basically the normal things that somebody might think of as income sources that I have. So once you have gross income figured out, you then have to take away some deductions to get down to taxable income, going back to the basic formula we had. So let's take a look at some of these above the line deductions as well as some of the below the line deductions so you understand how that works. Above the line deductions are often called deductions for adjusted gross income. In other words, they're deductions that you take to get you to adjusted gross income. Below the line deductions are often called deductions from adjusted gross income because they're deductions you take to get from adjusted gross income down to taxable income. So you have this concept of for and from or above and below. Let's spend a brief minute looking at some of the above the line deductions or again, deductions for AGI. These are deductions that reduce a taxpayer's adjusted gross income. Most of them are related to business or production of income activities, but there are some deductions that are permitted for individuals as well. Things like IRA deductions, student loan interest, educator expenses, just to name a few. Above the line deductions can be taken by a taxpayer even if the taxpayer does not itemize. An interesting point here is whenever there are expenses associated with a business activity, those are also considered above the line deductions because only the net income from the business is what's reported on somebody's income taxes. So it's sort of already been taken out before that takes place. Now that we've talked about above the line deductions, let's take a quick look at below the line deductions. And honestly, when most taxpayers think of deductions, this is really what they're thinking about. They're thinking about itemized deductions or standard deductions because that's pretty much the option that's available here. You can do one or the other of those two. When it comes to helping people plan for their taxes, it's really in a lot of cases helping them plan for and maximize their itemized deductions where a financial planner can really come in and make a difference for somebody. Again, taxpayers get the option of taking whichever is greater, their itemized deductions or the standard deduction that's available to them, which changes on an annual basis. Whichever one they end up using, that's what will be subtracted from their adjusted gross income to get them down to taxable income. So going back to our basic income tax formula, once we figured out how much taxable income someone has, the next step is to multiply that number times the tax rate to determine how much they owe. But as with most income tax items, it's not quite that simple. That's because, as I'm sure you are acutely aware, there isn't just one income tax rate. There are instead multiple rates, marginal rates in fact, that apply to one's income that are usually presented in the form of a table with brackets like the one you see here. The brackets are simply the upper and lower income levels for each tax rate that is applied to the taxpayer's income that falls between them, which I'll explain in just a minute. The tax brackets differ based on which of the four tax filing statuses apply to the taxpayer, those being unmarried or single, head of household, married filing jointly or surviving spouse, and married filing separately. The brackets are also marginal, not cumulative. And this is a great thing to share with clients, again, to demonstrate your professional competence, because believe it or not, there are a lot of people out there who don't understand the marginal application of tax brackets. Many people think that if they're in, let's say, a 24% tax bracket, for instance, they think they're paying 24% tax on everything they make. But as you know, that's not how it works. To illustrate, let's assume you're talking to a single individual who has taxable income of $125,526. A single individual with that level of income, they would be in the 24% bracket, which is between $100,526 and $191,950. So a lot of people, again, would think that their entire $125,526 is going to be taxed at 24%. However, what happens in reality is only the portion above $100,526 is in the 24% bracket, or in this case, $25,000. The rest of their money is taxed at the various brackets as they go up through them, as you can see illustrated in the table. So again, this is a great thing to make sure your clients understand, and just another excellent opportunity for you to demonstrate professional competence in the space. Oh, and one more thing. You can see here based on the bottom right corner, this is a tax table for 2024. They do change on an annual basis. So if you're happen to be watching this after the year 2024, all you have to do is do an internet search, and you can find what the new brackets are based on what the tax law changes were from the previous years. And with that, we've now reached the end of our basic tax equation. But as with the other elements we've talked about here today, we're not quite done yet. That's because once you've determined your tax liability, you still may have opportunities to reduce it, most often through the application of tax credits, which represent a dollar-for-dollar reduction in one's tax bill. To be fair, credits have qualification criteria, meaning you have to be eligible to take them, so they're not always available to everyone. But for those who do qualify for them, tax credits come in two basic forms. There are non-refundable credits and there are refundable credits, and the names pretty much explain how they work. If your tax bill is low enough and your applicable tax credits are high enough, either type of credit can reduce your tax bill all the way to zero. The difference between them, though, is that if the credit you're using is non-refundable, once your tax liability gets to zero, that's where its usefulness ends. However, if the credit you're using is a refundable credit, once your tax bill gets down to zero, you can get refunded any amount of the credit that is left. So, as a simple example, if someone calculated their tax liability to be $1,000 and they qualified for a $2,500 refundable credit, they would actually get $1,500 paid out to them, essentially causing them to make money when they file their taxes. But again, before you get too excited, this typically only happens with lower income taxpayers. So after any credits are applied, you've then finally reached the end of the basic income tax equation. All that's left to do is compare your calculated tax liability to the amounts that you had withheld from your paychecks or that you paid in as estimates through the year. If you owe more than you paid in, you'll have to pay the difference. But if you owe less than you paid in, you'll get a refund. The last income tax review area I want to cover today is capital gains, and I'd like to do that from three different angles. First, I'll cover the concept of basis at a high level, the reason being understanding basis is a critical component of understanding capital gains. And speaking of capital gains, the second topic I'll cover is how taxes work relative to them. And finally, we'll take a look at a specific type of capital gain, and that is the tax treatment of the gains associated with the sale of a personal residence. So let's begin with basis. In simple terms, basis represents the after-tax income that a taxpayer used to purchase an investment. That investment could be a business, it could be a mutual fund, it could be a stock, it could be a bond, it could be a lot of different things. But it's something that is owned for which capital was expended. It's important that taxpayers keep track of their basis in the assets they own, because when they ultimately sell the assets, they do not have to pay any taxes on the amount they spent acquiring those assets. The taxes are only applied to the gain, or, said differently, the difference between the sales price and the basis. So, for example, if you bought a stock, let's say for $1,000, your initial basis in it would be just that, $1,000. However, if you received dividends over the years of, say, $300 that you reinvested into your stock holding, your basis would now be the combination of those two, or $1,300. To be fair, there are other uses in the tax code for calculating basis, but calculating gain or loss is probably the most important one for you all to consider for now. So I've just been discussing basis from the perspective of when you purchase an asset. But what if you are gifted an asset or if you inherited it instead? What would your basis be then? Well, if you receive an asset as a gift, your basis carries over from the person who gifted it to you. So whatever their basis was, that's now your basis as well. Plus, if you had to pay any tax when you received the gift, you can add that on top of your basis. If you received an asset as an inheritance, it's actually better from an income tax perspective. That's because regardless of what the basis was of the person who passed away, your basis becomes the fair market value of the asset at the date of the individual's death. This is known as a step up in basis. And because of this, for people who have highly appreciated assets, it's often smarter from an income tax basis to pass them on to their heirs at death rather than sell them, pay the taxes, and leave behind what's left. To be fair, calculating basis can sometimes be a bit more complicated than what I've discussed here, but generally speaking, this is how it works. Now, let's switch gears a little and discuss a situation in which basis plays a big part, and that is understanding capital gains and losses. How much tax you have to pay when you sell an asset depends on a few things. First is the difference between the sales price and your basis. This is your capital gain or loss. Then there's a question of how long have you owned the asset. A holding period of less than or equal to 1 year is considered short-term, and a holding period of longer than a year is considered long-term. This matters because for income tax purposes, short-term gains and losses are treated differently than long-term gains and losses. All inherited assets are considered to be long-term holdings, regardless of how long the decedent owned them. And for gifted assets, if the fair market value of the asset at the time of the gift was greater than the donor's basis, the recipient gets to add the donor's holding period to theirs for purposes of determining whether it's a short or long-term holding period. I know that can sound a little confusing, but if you replay that and sort of write down the individual components, I think it'll make a lot more sense. And finally, the tax bracket you're in compared to the capital gains tax rate at the time will also affect the taxes you have to pay. So it's the capital gain or loss based on basis versus sales price. It's how long you owned or held the asset. And finally, it's the tax bracket you're in compared to the capital gains tax rates at the time. So what does all this mean? Well, generally speaking, the tax rates on long-term capital gains are more favorable than ordinary income tax rates. So the tax code favors capital gain income. To determine what this means for your clients, you'll need to have an understanding of the capital gains tax rates and rules in place at the time your client is making a sale, and you'll need to understand the three things I just talked about here. The last thing I want to touch on in the capital gain arena is around the taxation of a personal residence. Under current tax law, and this has actually been the case for quite some time, individuals can exclude from income taxation up to $250,000 in gains from the sale of a personal residence. For married couples, it's $500,000. As with most potential income tax benefits, there are a couple qualifications in order to be able to do that, though. First, you have to have owned and used the home as your principal residence for at least 2 of the last 5 years. And second, you must not have excluded the gain on the sale of another property within the last 2 years. Long story short, for many people, this is a great potential income tax break on one of the most significant assets they'll own. And with that, we've reached the end of the income tax review lecture. Did we cover everything? Not even close. Taxes are way too complicated and involved to have done that in such a short period of time. That being said, I do think we hit on some of the most important income tax elements you need to be aware of to be able to help your clients, and I hope you found it helpful.